GKFX presents the Market Analysis webinar. Hello everybody, thank you very much for attending. Hope you all had a fantastic weekend and looking forward to a good week of trading. I'm your host for today's weekly market analysis webinar where we preview what is coming in the week ahead through the price charts. We'll start with the major currency pairs and then switch gears to commodities and finally the US stock market. Of course, any particular markets you'd like us to cover, make sure to leave a comment in the video and we'll try to cover it next week. Starting with the euro, I often do start with the euro, but actually this week it's going to be quite pivotal because we have the ECB meeting where interest rates are going to get set in Europe, and that's forming part of our view here on the chart. So I've started with a longer term chart. This is the weekly candlestick chart, and you can see what we're looking at here is this is a downsloping trend line, and we have broken above that downsloping trend line. There was also an area of resistance here, which I've highlighted in this yellowy orange. We've broken through that area of resistance. So two areas of resistance broken out after a prolonged downtrend suggests that we potentially could be changing trends here. Now, these things don't happen straight away. There will be a pullback at some point. But the first area that could well be tested is this broken orange zone. Now, it's not an exact price level, but if you were to choose a price level, it would probably be this 112 round number. So if we jump down to the daily chart, you can see this in a bit more detail. Let me zoom out slightly. So this was the rapid move that we've seen over the last week and a half in the euro. And as a quick reminder, the Fed engaged in an emergency rate cut of 50 basis points, so 0.5%. So that's a big downward pressure on the US dollar. And on the flip side, we're looking ahead to the ECB. There's a good chance that they can't really match that because interest rates are already negative in Europe. So there's only so far they can cut them. The US interest rates are much higher. It's easier for them to slash 50 basis points this time, and there are many predictions they may do again in March. The ECB, it seems like they probably can't do as much. So if the ECB can't match these rate cuts, that's an upward pressure on the euro, and we're seeing that already. So this little red tick here, I put as a kind of situation A, if you like, a possibility A of what materializes next week, is that we get a short pullback from this. We've already started to pull back off the daily highs on Friday below 113. Perhaps we get a pullback towards this zone, towards 112. Then we look for some sort of confirmation, either at the 112 level within the zone, or perhaps even down at this broken trend line for a pushback higher. And then the major resistance, of course, we've got 113 and 114 to contend with, and there is some resistance up through these previous highs. But for me, 115, now that we've brushed through 110, naturally these currency markets tend to move in big five figures. So if we're through 110, we should be on our way towards 115. Of course, it doesn't have to happen quite as rapidly as this move. Another thing to support our cause that more upside is on the way is you can see on these past two previous occasions where we've hit the 70 overbought level on the daily chart, because it's been a downtrend, it's been the market's been swiftly sold off again. But we were in oversold territory and we went straight from oversold territory right up into overbought. That's quite unusual. And you can see that we pulled down out of overbought territory down below 70 on the past two occasions. That was a sell signal. On this occasion, it wasn't. You could see we only pulled down for one day, down from that downsloping trend line. No coincidence there, down from the 112 level. And since then, we've pushed to the top side. So I tend to think we're going to remain overbought for a while because we're in a new uptrend. Now, if we don't get the pullback from that zone, still the overall outlook to me looks positive. Just look at this monthly chart. If I go completely on a long-term basis here, look at the rejection of this. This is our downtrend we can see on a much smaller scale, but look at the rejection of that low here. This is a big reversal candlestick at a prior low, and we've had some confirmation so far this week, this month. Of course, the month hasn't closed yet. So to me, the big picture looks like it's turned bullish, but of course, we may not turn around at that level. Something else to look for will just be the kind of classic pullback area, which is between the 50 and 61% Fibonacci, and you'll see that actually an old area of support does sort of roughly match that 61.8. Should we get down to there, these old highs and these through lows would be the 50 if we pull back down that far. So that's the kind of game plan. It looks positive. Slightly less bullish if we pull down through the 112, decisively less bullish if we get through below that 61.8. Then it looks like the downtrend is resuming, and this was a false breakout. Let's switch gears to the British pound, to cable. Again, this is the weekly chart, and we've had a big area of resistance. This is what I'm trying to highlight to you, the 133 area. That is rejected price, 1, 2, could call that 3, 4, 5, 6 times, you could say. You could even argue 7. So 133, that general zone, has seen price turn lower several times. Once we get above that, in my opinion, that we're going to be off to the races, and more likely than not, we get a test of these highs up here, which is roughly 144, 143 if you're being slightly more conservative. So that's the big picture, but obviously that's from a weekly chart, that's not day to day. But you can see the more recent price action is we had a big push higher. We based out, after this downtrend, we based out, we had the big move higher up to the 130 level. We consolidated from there. We broke out again, another false break of the 133. And to me, this price action here has generally been a sort of similar thing, a pullback, although a bigger, longer pullback within the uptrend. To my mind, this broader uptrend is still intact. And why this particular price level is notable, we'll just look at this. You can see we perfectly rebounded with some good solid days worth of gains right off this 50% pullback level. So this big trend got a bit overextended at the big long-term resistance. It pulled back half, and now it's ready to go again, it looks like. But we're not quite there yet. We have made it through this prior peak. So of course, if we're thinking about why it would be an uptrend, well, it's making higher highs, is a characteristic of an uptrend. It has made a higher high. It's not made a higher low yet. So at the early stages, we're still basically within this range trading environment. For me, what I'll be looking for is potentially a bang into this resistance area up here, which if I use the crosshairs tool, you can see is about 130.70. Maybe it gets up to 130.70, a bit above perhaps, and then it comes down again within the general range trading environment, a drop through 130, and then that could be the kind of opportunity to then look for better prices for that move up for the retest again of the long-term resistance area. And we can't say that we're in this big bullish long-term picture until in fact we're above that 133. We're not there yet, but short term we're looking quite positive. So potentially 130. If things don't turn a bit more bearish, for example, we do have the possibility that the Bank of England do an emergency rate cut to match the Fed. They're in a similar position to the ECB in that the interest rates are still pretty low, are lower than in the US, albeit they're not negative. So they have more room than Europe. But in a week in which Europe is setting interest rates, and it's a week in which the UK have their first budget since Brexit, it seems unlikely that you'd get that sudden bolt of bearishness from an interest rate cut in England, but it's still possible. Let's switch gears over to the yen, and this has been one of the more fascinating and amazing trends of late in this really volatile period we've been having. This is the big picture where support is just underneath this big 105 level. And then the bigger picture support from back in 2016 is the 100 level. So it's between 100 and 105 that traditionally the Bank of Japan have heavily defended with interventions in the market to try and keep the yen fairly soft to support Japanese exports. And so we'll come down to that 105 level. I'm not sure that the Bank of Japan are going to intervene yet. But it's where we might start to hear some remarks. And so taking a slightly different view to the euro, where again, reminding ourselves that in the euro trade, the euro has rammed up massively because the dollar has dropped off. Here, the yen has rallied massively because the dollar has dropped off. So obviously the common factor here being that Fed rate cut and the dollar dropping. The yen is also a haven currency, so to get that extra boost too. But I think this move is potentially a bit overextended, keeping in mind that we're still in this range-bound environment until we're below 105 decisively. Maybe there's an opportunity for a rebound, but I don't want to catch a falling knife. This market is dropping rapidly. There's no evidence whatsoever of a bottom yet. We just know this 105 level is significant. We are in oversold territory. So let's look for us to come out of oversold territory, perhaps a close above 106, and then when the market tries to sell off again, look for potentially better prices. And don't get too optimistic about it. This is a very heavily falling market. If you are buying, it's risky. You're going against the trend. It's not to say that we're going to race straight up to 112 again. We do have a decent area of resistance above 107.50. So between 107 and 107.50 would be reasonable targets if we were to get some sort of reasonable bounce. Moving over to the Aussie. So again, starting with this bigger term picture, this is the weekly chart, and it's a big downtrend. Australia's been in a tough situation of late. China's economy has been slowing. China is Australia's biggest export market. They had the bushfires, and now they have the coronavirus, which is heavily affecting trade with China. So it's all quite bad news for Australia, and hence the Australian dollar is suffering. So that said, we have hit decade lows, so we are very oversold in the market. We've hit this big 0.65 level. There was a decent rally last week, so potentially we get some more upside here. But before we do put in a bottom, there's no evidence of a bottom yet. I'll be looking at this previous support to act as resistance. So here's the support zone through these lows over there. Again, resort there. It's basically the 66.70 if I was going to pick a level, but basically under the 67 area. Maybe we get a push through 67, and if that breakout above 67 fails, that to me would be a nice setup down towards the 65 round number again. But also worth noting that there is some bullish divergence here, so a big low in price, but not a matching low in momentum. So potentially a bottom taking place here in the Aussie dollar. Again, the Aussie's been so weak that people have been hesitant about buying the Australian dollar because of all the things I just mentioned. But if you look at the dollar yen and if you look at euro dollar, you can see how weak the US dollar is. Maybe the Australian dollar is just in a process of slowly catching up to those other currencies. Nonetheless, as I said, there's a big old support, potentially new resistance area that I'd first be looking to see if we can get any sell opportunities from. The flip side is if we do close above 67, that's quite a bullish turnaround for the market. And from that point, we start thinking about a trend reversal and looking for bullish continuation patterns. We're not there yet, though. Okay, so the last of our currency pairs, and this is the Canadian dollar. We're going to mix up which currency pairs we use every week, but the Canadian dollar has just been interesting, not from the big moves in the market, but also because the Bank of Canada also cut interest rates by 50 basis points to match the Fed. So Canada and the US now have equal interest rates at about 1.25%. So this is our long-term picture of the US dollar CAD, the loonie pair. And you can see that I've drawn in this downsloping trend line. We're still in a range, but I've drawn this downsloping trend line because I think we're moving into a bullish breakout of the range potentially. Obviously, that goes against our weak dollar trade in the other currencies, but in a way that's useful. If you can be long the dollar in one currency and short the dollar in another, then you're hedged yourself against the dollar. Of course, you don't do that for no reason. You do it if there's setups, but it does help you make sure that you're not just doing the same trade multiple times of just selling the dollar in every trade, buying the dollar in every trade. You're just you're just tripling your risk of the same trade. That can often be the case. But there is some evidence here, and then again, if we look down at the momentum chart, you can see that there does seem to be a bit of a downward sloping trend, a breakout, a retouch, and potentially off to the races here. And we've seen a slightly slower version of that in the price with the breakout. Now down to the daily chart. I'll just scrap that line. It doesn't make any sense when you get down there, but you can see this 133 to 133.50, it's not really been one of the round numbers really, but 133.50 you could say has been a ceiling for the price several times in here, but you could call that 1 or 2, 3, 4, 5, 6 time lucky, or maybe that was 1, 2, 3, 4, 5th time lucky is often the case in forex markets, in financial markets. So this is all fairly textbook stuff. Had the breakout of the resistance, pulled higher, got about 100 pips beyond the breakout area. We pulled back, we've retested, we're back up towards the highs. So this is all quite positive stuff. The only reason I haven't drawn like a little indication of where we might trade here is because we're basically right slap bang in the middle of the support and the resistance. So we've had one drop down to the support. That was really our opportunity to get into the market. Up here, we're kind of in no man's land, and the risk to reward, the reward is up to the next resistance, the risk is down to the previous support. There isn't really the opportunity. So all you can really hope for is actually we get a bit of a consolidation between 133.50 and 134.50, and then that gives us our lower risk opportunity to try and trade this breakout again. Okay, onto the oil market. Now, oil has been absolutely falling off a cliff. On Friday, the oil price dropped 8% in just one day, which is quite spectacular. And you can see this is our weekly chart, and the weekly sell-off that we're getting here is very reminiscent of the huge sell-off in price that we got in 2018. You can't see it on the chart here. 2014 was the epic decline in the oil price, down from above $100 per barrel. But in 2018, we had a pretty rapid sell-off, and it looks like we're in the process of well, we absolutely are in the process of doing that again. The backdrop is that we had the OPEC plus emergency meeting last week to try and contend with the coronavirus. The OPEC nations, led by Saudi Arabia, called for a 1.5 million barrels per day cut in oil production. Obviously, less oil out there means each barrel should be worth a bit more. It's basically an idea to push the prices up. They announced that. The following day, they had a meeting with Russia and some other non-OPEC nations that they've been partnering with. They wanted also to cut output by that 1.5 million barrels per day. Russia, being the main stalwart, said no. They only want to extend the existing cuts. And so that was a huge disappointment to the market. And so for that reason, the oil price has really collapsed. We are into oversold territory on a weekly basis now. So a bottom, you would imagine, is coming in. Just below 45, you can see was this kind of yellow shaded area from these lows in 2016 and 2017. So we're into major support areas here. And if we do get through that, which is entirely possible given the current momentum, then 42 in Brent crude is the next major level to look at. So those two big areas of support beneath us could at least lead to some sort of short-term bounce that we can trade on a shorter-term basis. Here's the daily chart. This market's and you'll see the same thing with the S&P 500. This market's moving so rapidly. You really there's not a chance to find setups on the daily chart. So this is when you have to move a little bit shorter term. Looking down at the 4-hour chart, even the hourly, I think I was looking at, and you can see this is again our big longer term area of support. When we were coming down and we broke through that long term area of support, you can see this low here has basically already worked in the past. We came down, we broke down, we got a reversal of about 47, pushed right up. That acted as resistance after having been support. We rolled over again. We got down to almost 45. You could see our 45 We tried to get a rally off there, and then we collapsed again into the close on Friday because the market is just so weak. But the best thing we could probably hope for is another push up to that previous low there, which we hadn't got to with that first rebound. So that is also just our key, pullback area between the 50 and the 61.8 of this little small. I say small; it's a big move, but we're on the hourly chart. So if you consider that to be the peak, you pull right down to the bottom. The 50% pullback and the 61 you can see is this kind of zone here where the market had been supported for a little bit. So if we are going to get a short-term sell-off, a rebound, and then a resumption of the downtrend, that would be the kind of zone for me to look for. It depends how weak the market is. You can start looking for reversals at this little short-term previous peak here. Though, as I said, it's kind of already worked once. So once it's worked, it's just less likely to work on the next time it's resistance. That's why I'd be more inclined to look towards 47 for a move back down towards 45, and then potentially from there to those big major support zones that we mentioned. 44.50 would be next little area if we take out last week's low. Moving on to gold. So this is the weekly chart. This is when we had the big bullish breakout. And gold has been absolutely off to the races ever since we did that. 1370, I suppose, was the big one. And bigger picture, while we're above that 1370, I still remain pretty positive on gold. But then if we're taking price a little bit higher than there, still above 1550, I'm even fairly short-term positive on gold, and actually we did get a pullback to that area. You see that was the high. We had this little bull flag consolidation. We've had it a couple of times now. Then we had a triangle. We had the breakout, and I think we're probably coming towards the top now for a period in which we actually could take out some of the prior lows. So just the fact that we got up to that 1700, we're potentially in a kind of double top situation here. This sell-off here, you'll notice, is bigger than any of the, markets are very volatile right now, so the sell-offs will be bigger. And we have made new highs. So this market is still very bullish, but I'm looking at that sell-off as potentially the first sign of a topping situation in gold after a very good run in which I've been bullish above this broken resistance. But we've had quite a few bullish breakouts, and I think probably it's time that we take out 1550 as the major sort of medium term, if you like, support. And then maybe we don't even take out 1550. That's certainly a level to watch out for. It's the previous high, and then it's the lows throughout this consolidation area. Maybe we're just in for a kind of range-bound period again, and yet another bullish breakout. But I think this tells us that the market's a little bit oversold. You never truly know the reason for these things, but it was reported that there were a lot of margin calls in the stock market, and so people took money out of their winning positions, gold, which has been moving very strongly higher, obviously, and took that money out of the winning position in gold to cover their margin calls in the stock market, which has obviously been plummeting, with the idea that the stock market's going to recover, and when it does, gold won't perform as well. There's a certain logic to that. We probably will get a bigger bounce in the stock market at some point. I'll look at that right next, actually. And these two markets somewhat correlated, though even if we do get a massive bounce in stocks, I don't think it means that gold immediately turns into a bear market or anything close. The trend very much positive in gold still for the time being. But 1700, potentially a topping area. I would not be looking to buy up at these lofty levels. We certainly can push higher from here, but the risk to reward doesn't really favor a trade. So last but not least, we've got the S&P 500 as we tried it, the SP 500. Here's the weekly picture. So this was our first major area of consideration, these two old highs here, the 3020 level. We blasted straight through that in 1 week. And indeed, the next area of support was the 29.40, 29.50, you could say, from this peak, between 29 and 2040. Again, blew straight through that as well and came right back down to this, I forget the month, it was, September's low. So, and then we found support September's low and moved rapidly up towards above that first area of old support, now resistance, but not quite up to this one on a closing basis. And then we've had 1 week since, and what you'll notice here, maybe it's clearer from a daily chart, is that we have pulled back exactly 50%. That's why the market pretty much ended there. There wasn't anything particularly notable about 3,100 or 3,136, but it just happened to be the 50% pullback of this entire big bearish drop. And so then the market's pulled right back down to the lows down here. And again, because markets are moving so rapidly, daily charts, not so useful. You really want to drop down to the 4 hours and the hourlies because the markets are moving around so rapidly. You need the detail on the shorter term charts. And for the moment, even though we're obviously in a very volatile market, but don't get too caught up with the fact that we had this massive previous downtrend, because actually at the moment the trend is sideways. And so when we take out when we take out the lows here, then the downtrend is resumed. And this certainly could be a pullback within the downtrend. But as I say, it's kind of chopped around. So for the time being, we're consolidating. And if we are trading on a shorter term basis, then actually the current trend on the 4 hour chart is sideways. It's not down. And on that basis, we can trade both higher and lower. Admittedly, the higher probability trades are probably to the downside given the prior trend. But it just so happens that we're at this previous area of support, 2,900. You can see we came down once, tried to push higher, failed, came down a second time, probably took out a few stops down here. The banks were taking out anyone who'd been buying the market under these levels, pushed them out, and the market's pushed higher in the final hour of trading. And so that's why the losses on Wall Street were not quite as bad as they initially as they had been for most of the day. The Dow was down 900 points. I think it closed down around 300 points in the end. The S&P 500 was down around 3%, and I think it closed down around 1%-ish. And so then it's a matter of whether we can find a decent level to try and trade back up to the top of the trading range again. And then when we do get to the top of the trading range at some point during the week, which I suspect we quite possibly will, look for short-term opportunities to sell the market in this trading range until we get the breakout, and then we start trading on a kind of trend trading basis again. That's it for this week. Thank you very much for attending. And again, if you enjoyed this video, make sure to follow the channel and like the video. And if there are any particular markets you'd like me to cover next week, then certainly please drop a comment in there, or any comments whatsoever that you have. Happy to hear them. Thank you very much, everyone. Have a great week trading.